speakers covering some fantastic topics, and we continue today with some more speakers, all with giving out their time and their effort to help young companies get going and support you in the growth of your business. Got some fantastic talks. This one's all around commercialization. So we've talked about finance, so talking about the money you need to get yourselves going. Talked about people, building the best team, maintaining them. We've talked about product and customer and a little bit about market pull. But today is all about the big piece. It's about making money out of everything. And that can be from going out and raising money to move it forward. It might be licensing your IP. It might be selling your business. We've got two fantastic case studies, one from Mariam at Datalink and one from Alistair at Septest, who were last year's winners. So just to hear a bit about his journey, what's happened in the last year through the Innovation Challenge, and hopefully what that's brought to the party, and then what's new and exciting for him. Mariam's journey is absolutely fascinating, and I really hope you get a lot out of that as well. So please keep your cameras off, please keep your microphones off. I am running the chat on the side. It'd be fantastic if as we go through you can ask questions. All the speakers are quite happy to answer questions as we go through, so just pop something in the chat and I'll get that introduced to each of the talks as we go along. Okay, next page. So a bit of housekeeping, I've talked about that. We have got 2 10-minute breaks built in. It's likely that we're just going to go for one because we do often run a few minutes late, and just to bring back some time. If you don't want to put your question in the chat, it'd be great if you could just raise your hand. I'll spot that and ask you to just ask a quick question. We have got a lot to go through, but the more interactive it is, the better it is for everybody. What an amazing picture this is. This is all the people that have contributed to the Innovation Challenge this year. You know, a big thank you to Shakespeare's for being our headline sponsor, and then some of the other key sponsors are Modus, Foresters, Kodaks, and CPHI and IMED. All the other people are contributing towards the big fund at the back end, which is part of the Innovation Challenge. But all these people you see there have kindly donated their time for us and bring some fantastic workshops alive and bring them to you. But a big thank you to all our sponsors. Without them, we won't be able to run the challenge, and we won't be able to put that help back into the business community. There we go. Ed Wright from Shakespeare is going to be saying some words later on about licensing. So a big thank you to Ed as well for giving up his time from Shakespeare's. So these were the 4 workshops that we ran. I think they've been absolutely brilliant and so informative, and it's a bit like Donald's Rumsfeld, which I'll mention a bit later. It's the unknown unknowns, and hopefully you've got your eyes wide open about some of the things you need to know about moving forward. Okay. The Innovation Challenge, the workshops are the precursor to the Innovation Challenge. So it's really to get you up to speed with what you might need as an entrepreneurial business in the first kind of 3 years. The main event is going to be the Innovation Challenge, which opens as we close this workshop, and it's a business competition. It's for startups or 3 years and younger. If you are slightly over 3 years, but you're still heavily involved in R&D, you know, that's still likely to be okay, but just give us a quick call or pop us an email. We'll have a chat with you. It doesn't matter whether you're in the marketplace, it's just a brilliant idea and you're just building up the concepts, or you're partway through the R&D phase. But it's kind of technology-based businesses. Really looking at smaller businesses, so kind of sub 50, so not anything terribly established. You might have raised your first round of funding, but so far we've had over 100 people registered to take part, which is absolutely amazing. Last year we were up at 65. We narrowed it down to the top 10. From the top 10, they got to pitch live at the Innovation Showcase, which will be October this year, and down at the Leicester Space Centre. And they got to pitch live, and then we announced 2 runners-up and a winner. So there's a bit on the eligibility, and I think Joe from my end is going to talk you through the application process towards the end of the workshop today. So the prize funds, these are all the fantastic contributions that a lot of the people who have done talks have contributed into it. So Shakespeare's legal support as example, Modus first year accounts, Forester's IP, and I know Alistair at Septest has got some words to say around that. The CPHI, this is an opportunity for medtech or life life sciences type businesses to actually go and have a stand over at CPHI Milan. And that's part funded through MedTech Makers Lab, who have kindly funded the flights and the accommodation. So it's like an all-inclusive trip without the alcohol. But yeah, it's a fantastic opportunity to go and showcase what you've got. Oxford Product Design, really great. They talked about their own product design services and how they've helped companies. Crowdpoor, that's Liam. He's going to be talking later today on the PR. Just some fantastic access to real professionals in their industries. And of course, the £5,000 cash prize, not to be sniffed at. Okay, the application window opens today. It's opened until the 18th of August. We will be circulating these slides, but tbat.co.uk, you can see straight away from there the Innovation Challenge. You can follow that through. That's the direct link, and there's a QR code as well. Okay, why run a commercial workshop? I mentioned Donald Rumsfeld. It's quite easy in business there's things you know, which is great, and there are things you don't know. So that's also fairly great because you can go out and find those things, you can talk to people, you can get your answers. But certainly what I found out in business is that there's an awful lot of things I don't know, and they're the things that can really trip you up. And the background of all these workshops that we've run, pardon me, is to bring it to life and open your eyes to some of the wider issues that you might find in your business, but where to go out and find out some help and some information around how to resolve them. So commercial workshop, let's make some money for all the great ideas you've got, the hard work you've put in to date. It might be raising the money, it might be launching into the market, it might be licensing your tech, it could be selling your business. Loads of way to get you the rewards you deserve for spending time and effort building your business. These are the speakers. I'm your host for the day. Quite a familiar face. I've been doing these for this is our third Innovation Challenge, and I hosted all of last year's in this lots. I love these workshops. I think they're brilliant. We've got Ed, Mariam, Mukesh, Christian, Liam, Alistair, and Hugh. Terrific array of business professionals, and as I say, and the real life case studies from Mariam and Alistair, which I think are going to be superb. Okay, investment readiness. So a mini IRP, investment readiness program. Hugh Sparks is an investment manager at Midven. They've worked with on these workshops for the last 3 years. I've worked with Hugh and Midven for quite a number of years now, and they're a great place to go and talk to. So, Hugh, are you going to share your screen?
I am indeed. Let me figure this out.
I'll stop sharing there.
Let me prepare this. There we go. Good afternoon,
Look at
everybody.
This. Seamless this is.
Not my first rodeo, Sam. First of all, apologies for my camera not being on. My laptop has had many things added to it by our company over the last few weeks, and disabling my camera was one of them, unfortunately. But good afternoon, everybody. Thank you very much for joining. My name's Hugh. I'm an investment manager at Midven. We're a Birmingham-based venture capital fund manager that has been investing into early stage companies with a focus on the West Midlands region since 1992. And in that time, we've supported well over 200 companies and had some fairly spectacular exits from all of those companies as well, including to the likes of Samsung, Apple, Arm, and many others. We are a fairly small team in this office, and I do find it quite funny that the only photo that's not loading there is my own, but hey ho. And the fund that we are currently managing from this office is the West Midlands Co-Investment Fund. This is a £25 million pot of cash invested into by the West Mids Combined Authority and a pension fund from this region. It's designed to spur investment into the region from outside the region. The West Midlands suffers from not having enough investors, really. We are one of, we think, 3 venture capitalists who actually have an office in the region. And so this fund is designed to invest into any type of company, pretty much, as long as you are based within the WMCA region between Wolverhampton and Coventry, have revenue of over 100k, and are looking from us for between 200k and £1 million as part of a round where we can at least match that. So we are trying to build in value added syndicates for investors with every investment that we make, since we are a very generalist investor. Companies in our portfolio have access to our parent company, which is Future Planet Capital. Midven's been part of their group since 2021. They have a global impact mandate, so anything that is addressing sustainable development goals in their specific focus areas, which change fairly regularly, are accessible for fairly large sums of cash through any
You
of
know,
their funds.
Hugh, you know the West Midlands Co-Investment Fund. I was chatting to one of the companies that you guys invested in. So they were outside of region originally, but based fairly close. But that they've now set up an office in the West Midlands, and because of that, you could I think co-invest on the back of that, as opposed to it's all about creating wealth in the West Midlands, isn't it? That fund.
It is, yeah. It's designed to firstly spur innovation, so investment coming into the region, specifically from London. The UK has a huge issue between London and not London for early stage equity, but also to encourage companies to move into the region. And that's something that we're starting to do a little bit more of at the moment, which is encouraging companies to move from wherever they currently are
Yeah.
into the West Midlands region. You have to be quite careful because officially we have to have them there already. But yeah, it's something that we are working on at the moment.
I've never seen rules as rules, you see. I see them as guidelines.
I'm sure. I'm sure it works very well with HMRC and the R&D tax credits.
Well, there are some people where guidelines are actually rules in that case, but there we go. That's a whole subject I don't want to go into right now.
Absolutely. Excellent. Well, today what I'm going to be focusing on is how to write an investable business plan. There's loads of free advice out there. You can search Google how to write a business plan and it will tell you how to write a business plan. But when you're pitching to a venture capitalist, that's what we're talking about here, there are a few very specific things that you need to have in that plan that are often missed. And that's what we're going to be focusing on today. But the first thing to really focus on is, where are you in the ladder of funding? When you first start out, you're in the bottom left corner there. You are a very small company, maybe pre-revenue, maybe even pre-product. And what that means is the availability of finance that you have is very low. There are very few people willing to take a chance, a commercial risk, on a company with no traction. And that means you start off with grant funding. It's free money and it's typically gets you from point zero to point one in your journey. But grants are limited in their capacity, and so you move into private funding from one of the three Fs, or a collection of the three Fs, which is your family, your friends, and the fools who might invest some of their spare change into your business. But again, the three Fs probably run out of money fairly quickly unless you're from a very specific background. And that's where you move into angel funding. Angels are high net worth individuals who have maybe been entrepreneurs or business owners in a previous life. So they can not only add cash to your business, but also their time and their knowledge to your business to help you grow as a company using their experience. But again, angels investing their own money might only have 50 to 100 grand at most to invest into a business at once. So what venture capitalists do is they manage other people's money in a fund. We don't manage our own money. We are custodians of other people's cash and we invest it on their behalf, which means that we have access to a lot more money, as you can imagine. But something worth just really highlighting here is see how far up the ladder we are in terms of the size of a company before venture capital is the most appropriate source of funding for you. And a mistake that a lot of startups make is they think that the venture capitalists are there to invest into pre-product businesses. And the reality is, unfortunately, that that's not what we are best at doing. There are some pre-seed venture capitalists who do that, but it's not typical for us. So what's important when you're talking to any venture capitalist is to understand that your company matches the criteria that they have as an investor. For Midven, it's £100,000 of turnover within the last year.
Any digital equipment used on
Oh, hello.
site must have an official
Okay,
UK
I think is that Dimitri. If you could turn your microphone off. There we go.
Yeah.
She's multitasking, whoever that is. But okay, so
Oh,
with
okay.
VCs, they generally want to see some level of market pull through turnover. Is it then, Hugh?
Generally, so where we're going to come on to is venture capitalists like to invest into companies which have what's called product market fit, or have at least identified a problem solution fit. So companies which are pre-revenue, the expectation that a venture capitalist will have on you is just a bit higher than that which an angel has on you. So what you've got to remember is VC is a source of funding. It is not the only source of funding.
Yeah.
And every business needs to be able to recognize when it needs the different sources of funding. because sometimes debt will be an even better option for you. Sometimes angel money will be better the whole way. And sometimes you need to go within the different realms of VC, all the way from pre-seed to Series A, B, C,
Yeah.
etc. So for Midland, we are
and kind of those decisions there, Hugh, are all based around understanding the cash flow forecast of your business, isn't it? And what your growth trajectory and what money is going to be consumed to allow that growth to happen. So going back to the very first workshop, which was all around the money, understanding cash and finance and balance sheets and profit and losses, absolutely essential. So where you've got a clear idea about what levels of funding you need and what shape they need to take, be it, as you say, debt or equity.
Absolutely.
Yeah.
So if you look on the Midfend website, you will see to apply for our funding, you need to have these three things. You need to be based within our region or relocating to be in our region. You need to have at least 100,000 of revenue within the last year, and you need to be trading for less than 7 years. Fairly straightforward. But we've made 5 investments from this fund so far and seen about 900 business plans to get to that point. So what do those 5 have in common before they get down through that cutoff? Firstly, we are normally invested into our companies for 5 to 7 years. And what that means for us is we need to trust that the founder is going to be going on a journey with us. And that means that they're being open to learning new things and being able to recognize that there are some things they are good at and some things that other people are better at. Founders that we invest into are always exceptional at something, but they are able to recognize that there are some things they are not world class at. And that's what building a team around the founder is all about. So firstly, exceptional leadership is our main thing. Secondly, there's something that we call an onlyness. Can you as a business say that you are the only X that does Y in a certain way? Because ultimately, if you can't say that, then you're either competing on price or on service, either of which someone can come along and raise more money than you and do better than you. If you are able to say you're the only person who does this, then you have a much more compelling business plan for us to invest into. But the onlyness is important, but why are you the only one? I mean, I could stand outside the cinema and sell dog food flavored popcorn. I'd probably be the only one, but that doesn't mean I'd be popular or investable because I'm not solving a market need that people have, which is where what we term the equity story comes in. Equity investments are different to debt investments because we only make money when we sell our shares for more than we bought them for, which only happens if the company grows quickly and loads of people are really interested in what you do. An equity story needs to be easy to follow and capture the hearts and minds of all of your potential stakeholders. And as a way of thinking about this, imagine that your business is a jigsaw puzzle that you have designed. You know exactly what the picture looks like because it's your business. However, when you are pitching your business to somebody else, they haven't seen the picture on the front. Our first job as an investor seeing a pitch deck is to try and find those straight edges, put them together, and then figure out what the middle of the picture might look like, working our way inwards logically. If your pitch deck is unstructured, cluttered, confusing, you're doing the equivalent of throwing 3 jigsaws on the table at once and expecting us to know where to start. So your pitch needs to tell a story, and your story needs to be easy to follow with a single goal or a North Star that everyone in the business is aligned towards achieving.
Just a quick question on the onlyness comments that you made on the previous slide, Hugh. So I've worked with one company and it was a change in legislation that drove to the market opportunity, and it seemed like nobody had been developing a solution for that, and they had been involved in the early discussions about the change in legislation, all to do with reporting holes in the highway, and so they were first. They received investment because they could you couldn't prove what the market was because the legislation was going to create a brand new market, but you could base it on the number of holes that were dug in the highways of the UK and make some extrapolation about so what all the USPs were and why it was a differential approach. So the onlyness for them was we're going to be first to market, and there's a clear drive and need for this from new legislation, as opposed to an existing market where you're quicker, faster, meaner.
Yes. And it's an important distinction, because obviously you don't want to be the only one in the market because there's no market need for it. What's the saying? Beware the watering hole the antelope refuse to drink from. You don't want to be the only one in the market because the market doesn't exist, for example. So, and that's where the owniness is important, but just as important is the equity story that goes with it. Which brings me nicely on to the compelling investment proposition, which the most important part of the equity story is that you're demonstrating that you solve a market need. And now, to try and put this into practice, there's a slightly vague metaphor that was told to me ages ago. When you are surfing, which I do not surf, if you could see my camera, you'd understand why. I am not a fit person, but when you're surfing, there are four main things that you need to have. Firstly, you need to be a good surfer. You need to practice. You need to be able to read the waves around you and know what to do in certain situations. The wave needs to be good. It needs to be the right height, the right speed, breaking at the right time for you. You need to be on a board which works, is well prepared, is the right size for you, has all the things that you need in it. And then all those things happening, you need to hit the wave at the right time on your correct board. Everything needs to be happening in harmony at the right time. And when we're evaluating a business plan, it's the same four things. Tenuous, bear with me. Firstly, we need to see a product which solves a genuine market problem, which is your surfboard. We need a market which is big and growing and ready for innovation, which is your wave. We need a team which is up for learning and able to execute on the business plan that they sell their investor, which is the surfer. And finally, all of those things need to be happening at the right time in the marketplace. And the companies that we've invested into, of those 800 or 900 business plans that got down to 5 investments, have all been operating in that middle section there, with a product, market, and team all operating in harmony at once. So, starting off with the product. Venture capitalists love problems. Now, some might say venture capitalists love creating problems. That's not what we're going to go into here. But what we want to understand with every product that we see or every service that we see is that there is a problem that you have identified and that you solve. And so we love to see problems which are popular, which have millions of potential users all around the world, which are growing at maybe 20% per year, which are urgent. This problem needs to be solved right now. And maybe that's because it's very expensive. It currently costs billions per year to solve this problem with existing methods. If there's a legal change that's coming in that makes it mandatory to solve this problem, medical is a great field for this, where regulations change all the time. And finally, frequency. Do your millions of users all around the world face the problem that you solve multiple times every day? Now, you don't need to have all of these. You don't need to be able to say that your product solves all of these problems. But if you're unable to say that your product identified any of these problems, it might be worth reconsidering where the market demand is going to come from for your product. Because what you really want to avoid being is the dreaded SISP, the solution in search of a problem. Now, this has been a huge issue in the past. Anyone remember blockchain? This was one of those. It was one of those great solutions that nobody really knew what the problem was that it solved. So that's exactly what you want to avoid being.
I was chatting to somebody yesterday who he said, I've got this great idea for a product, and there'd been a court case, and I was really, and some legislation was coming through, and I was really trying to get him to explain. I said, you seem to have a solution, but you're not really defining the problem, as in, why would somebody buy this and who's going to pay for it? Great solution you've got, but I'm really worried you're investing a lot of time and effort and trying to get investment, but is anybody actually going to buy it? Because are you really solving a problem? You've got a great solution, but is it solving a problem? And it is really hard for the fella to enunciate exactly what problem he was solving, which would make it a compelling reason why somebody would buy it, to get over that problem.
Yeah.
And you're absolutely right. A solution in search of a problem.
And there's a very good book by someone who I'm not so keen on called Simon Sinek, called Start With Why. And his point of the book is that everything you do in your life should have a purpose behind it. But the same principle applies to your business plan. If you didn't start your business because of a problem, then it's very unlikely that other people are willing to pay to have it solved for them. So that's always worth considering, starting with a problem and then finding the solution to it. I'm going to skip through the market section, but firstly, there are two ways that you can define how big your market is. You can do the most common way, which is a consulting firm says this market is worth X trillion dollars per year, and the dreaded words, all we need to do is get to 1%. Or you can start with the way which is much more compelling to an investor, which is how many users are there in your target segment? How many people face your problem that you solve? Multiply that by what's your average contract value per year per user. When you multiply the two together, you have a market size of your first segment. And now you can add different segments together based on which problems that you solve for different user groups. But it's a much more compelling way of telling us how big your market is because you started from the bottom rather than from the top. And as a rule of thumb, a venture-backed company, we typically look for markets which are at least £300 million per year as a total market. If you solved the problem for everybody in your primary market group, you would be on £300 million per year of revenue, on the understanding that you don't need to get everyone in the market to create a fairly large business. And I mentioned timing earlier on, and this isn't just me that says timing is important. There was a piece of research done by this chap, a guy called Bill Gross, a couple of years ago. He ran an accelerator called the Idea Lab because he thought the most important factor in a startup success was the idea that the company had. But what he found after going through hundreds of companies that had been through his accelerator is that it wasn't the idea, it certainly wasn't how much funding they raised, it was the timing with which they entered the marketplace. And some of that, unfortunately for many entrepreneurs, is partly luck. The examples he gave were Airbnb, which did not receive any investment for years before it launched properly immediately after the financial crash of 2008, when all of a sudden renting out a spare room in your house to a stranger pivoted from being a really weird idea to a very easy way of making extra money at the point when you needed it most. So why is now the right time for your business? It's a very important question that we are going to ask you and something that you should consider.
So did Bill Gross do that across tech sector, or was that multiple sectors he took his data set from? Do you know?
It was predominantly tech companies because he was a Silicon Valley investor, but there were a few other sectors involved.
Yeah.
But his main point was it doesn't matter particularly what your business model is, what your idea is. What matters is why is now the right time for you.
Yeah. And it's interesting that the team, the jockey that they back is probably a bit more important than the actual horse itself, because if you've got a great team, they will, there's a better chance of getting anything delivered, isn't there?
Yeah, well, I imagine the jockey can jump horses mid-race.
Yeah.
You can change your business model, you can pivot your product, but the team is a bit more constant. So
yeah, I was doing one talk, and a guy was chatting about teams, and he put up a picture of the Microsoft team back in 1980, whatever, very late 80s, early 90s. And he said, would you invest in these? And you instantly thought, you didn't know who they were. You thought, whoa, they all look like, nerds, out of date fashion, all the rest. You want to invest them. And then the next slide was they're now a, 1.6 trillion pound business. And you thought, oh yeah, because they had the skills and they had the timing.
Exactly. The next thing that we often see come up wrong in pitch decks is competition. Now, I've lost track of how many of these I've seen in my years in venture capital. Firstly, competition is not a bad thing. Competition means that there's a big enough market to go after because there are other people trying to go after it. But there are much better ways of showing who your competition are than by cherry picking features that you have that your competition doesn't. The buyer's motivation when they're making a purchase in this instance is very different if they're in the market for a Rolex versus in the market for the Frog watch, even though by cherry picking these features, the frog watch looks better. I mean, it's a frog. Way better. A much more powerful way to show who your competition are is by showing what problems you solve for your customers, and then going beyond that to say why that actually matters to your customers. You could solve all the problems in the world, but if they are cheap to solve or not mandatory to solve, or there's not very many of them, it doesn't matter how many problems you solve. Going back to our earlier slide, why does it matter that you solve these problems? And then have some understanding below of how you defend against your competitors. Because unfortunately, first to market doesn't necessarily mean last in the market. How are you going to defend your position against other competitors coming in against you? But fundamentally, how are you different to the rest of your competition? Think about it in the sense of business is not really fair. So what is your unfair advantage that means you will beat out all of your competition? Finally, we've gone through products, we've gone through markets, and now we're into team. Particularly at the early stages, team is really important because when there's not much commercial traction to go and understand, we rely very heavily on knowing what the team is. So know what's your company structure? What does each member bring that means you are greater than the sum of your parts? And then what shareholding do they have? And fundamentally, how adaptable and resilient are you? Business is hard. Startups are harder. And the great Mike Tyson would be very good in startups. Everyone has a plan till they get punched in the face. So what makes you as a team resilient and able to adapt to what's a really hard slog, building up a team, building up a startup? And at the early stages, it's going to be the team that you have around you.
And with that team piece, Hugh, you've got your internal team, as in your employees, stroke partners in the company, other shareholders, and then how important is, if you like, an advisory board or an external CFO or an external, just a non-exec? So more of an advisory board. Are you looking for? Are both of those important, or is it more the core team you're interested in, or?
So what we want to see really is that the leaders have identified where they are strong and where they could be stronger. So a founding team should always try and balance itself on that basis. If a CEO is great at visionary and big picture stuff, they need a managing director or a COO who is good at the detail to balance that against them. We're not expecting the founder to be perfect in every way. In fact, we'd much rather they were world class in a couple of things and hired other people around them to fill in the gaps.
Yeah.
In that sense.
And sometimes by the time you get to the VC piece, is it that the founder may not be the best person at all to be running the company? So
it can be the case.
Yeah.
There's one of my companies that we invested into last year where the founder is actually only involved really in the marketing side of the business now, and they brought in a chief exec to actually run the business. And in that time, the business has gone from about 3 million valuation in its first round to targeting 25 in its next round.
Yeah.
In a 2-year period. So that CEO has been very good for that business.
Yeah.
But that was only possible because the founder recognized that they were not the best person to take that business forward.
Yeah. And
but they were the best person to
do you sometimes have to tell the company that, Sam, you've done really brilliant with the company so far, but to be, if we're going to invest this much money, we're going to be looking for you to put in place an MD and you become the CTO or some other role that you're still involved and still important, but you're not actually running the business day to day.
It's not a conversation we like having. It's a conversation we'd much rather the founders were willing to have with themselves at some point. But it has been said, maybe Gymshark is possibly the best example of that. When Ben Francis founded Gymshark, he was CEO. And when he brought in Paul Richardson as chairman, he was no longer CEO.
Yeah.
Paul Richardson hired Steve Hewitt to be CEO, and Ben was head of marketing instead, because that's where his main skills lay.
Yeah.
So, but that was one of the crucial decisions that led to Gymshark being as successful as it has been in the last decade.
Yeah, we've got a couple of minutes here, and I'm seeing you got kind of 12 slides to go.
Shimmy through these ones. So, when you take on equity investment, we make money by selling the shares for more than we bought them for. But startups are not easy to shift. It's not like a public stock where you can just go on your phone and sell some shares to someone else. So what we need to understand from the founder is that you are able to go on the journey towards an exit point. Now, we don't need you to tell your investors exactly how they will exit. No one expects you to be Mystic Meg in this situation. But what examples can you give of companies in your sector that have been acquired? And what examples can you give of valuations that have been paid on exit? And really, are you willing to go to that exit point with your investors? But knowing the valuation on exit is all well and good. How do you know the valuation on the way in? Now, I'm going to try and keep the maths as easy as I can here. But one of the objections that we have to equity investments is I don't want to sell my shares to someone else. But that's not how an equity investment works. If an investor offers you £500,000 for 20% of the business, they don't take 20% of the shares off the founding team. In this example, new shares are issued by the company. The investor buys those shares from the company, and post-investment, there are more shares in that company than there were pre-investment, which gives rise to these two terms that you will hear a lot: pre-money and post-money valuation. Now, those are based on the same share price, more shares after than there were before. The founders will have the same shares that they always did. And this will happen in the next round. The next share price might be £5 and then £15 per share. The founders will still have the same shares. They might own less of the company, but they will still have the same number of shares with the share price going up over time. So how do you know what to raise at? Well, early stage, it's very difficult to know what valuation to put on your company. But as a general rule of thumb, the average or median first round pre-money valuation in 2021 was just over £1 million, if that gives you a vague estimate as to what you could be targeting. And the second round valuation was about £2.5 million. Now, you can be higher or lower than that, and that will depend on many, many factors. But if you are growing very quickly with protected IP and a very hard market to get into, that will increase your valuation. And the opposite is also true. So when it comes to maximizing your chances with investors, firstly, leave yourself long enough to do so. From start to finish is, with us, around a 3-month process. And we are about as linear as it gets in
That
this
is
marketplace.
quick, isn't it? Yeah.
So it will take longer
But
than
is that
with
from
many
you
investors.
seeing a strong business plan and kind of making a decision? Yeah, I love this. To close is 3 months.
Generally, if everything falls into place and every piece of information we ask you for you have on hand, it's around 3 months between the first meeting we have with you and money in your account. But if you're not prepared for this and you don't have the data room ready and you don't have a financial model ready and you actually need to go and hire half your team before you can raise the money, it's going to take longer than that. So leave yourself time, because if you go to an investor with 2 months cash in the bank, you're not going to make it to the end of that process before you run out of money.
So just thinking about that, Hugh. So you've done your cash flow forecast, you say I need £2 million over the next 2 years. That'll give me the cash runway I need. If after the first year you've been meeting all your milestones like you said you would do, you've now got a year of runway left. Is that the time to go back out to the market? No, it's going to take 6 months or more, but you're in a really strong position because you don't need the money. You're not in distress. You've still got a year of runway left, but you've achieved some great things. So you've got a good story set. Is that a good time to go?
Absolutely. So you should always try and raise in a position of strength where you don't need the investor's money within the next couple of months. Now, always try and raise at least 18 months of cash flow for you each time, because that gives you a year to execute on your business plan and reach those milestones before you need to go out and raise any more money.
Yeah. We're running over a bit here, Hugh, I'm afraid.
Yeah, I'm finishing off now, but I'm not going to read these out. That's how you can just maximize your chances. But fundamentally, it all comes back to this: have you identified a problem and built your product around it in a market which is ready for you to innovate with a team that can execute on your business plan? That's how you raise proper money in this economy. That's my LinkedIn.
Yeah.
If anybody would like to have a follow-up chat, thank you very much. And sorry I ran over ever so slightly.
Yeah. Thank you. You covered so much there, and some really interesting points about your business plan and how to justify it. And I think I quite liked your comment then. Think, why does it matter? You've got this great idea. Why does it matter to people who might buy it? And I think that is a great one-liner. I do like that. And I think when Christian's going to come on next and he's talking about, putting together the pitch deck, which is just such a parallel fundamental piece to the business plan. The pitch deck opens the door to present your business plan. So really looking forward to what Christian's coming up with next. But Hugh, there is a question on the chat, Hugh. I don't know if you can kind of answer that just before you go. Thinking about the addressable market, if you find a method to identify your potential customer base, as long as you can show how you calculated it, is that okay for you as an investor? I think it's having that equity, that story, isn't it, and being credible with how you've put it together, isn't it? And
yeah,
you can
exactly.
evidence it.
I mean, there's no correct answer to how big is your market.
Yeah.
But if you can identify your niche and how many potential users you have within that niche, then that's a good start for that. And what we try and expect you to do is really be quite narrow to start with, because that's how you can gain traction.
Yeah.
And then you can look to expand it over time.
Yeah. Lovely. Hugh, thank you very much indeed. Tony Dye, if you could pop your camera off, please. That'd be great. Yeah, there he is. He's just having a quick look round. Okay, yeah, if you've got any questions for Hugh, you can either put them in the chat and maybe he'll be able to answer those as we're going along. But Christian, hello. Good afternoon.
How are you?
Yeah, really glad you could make it. I was getting a bit squeaky bum moment because I think you got distracted doing lots of other things, and I think a little under the weather perhaps. But wonderful to have you with us. Big thank you for supporting the CPHI trip with the support around the travel and the accommodation for those people. I think for medtech companies and life sciences, that's going to be a great opportunity should they win that part of the innovation challenge. But the perfect pitch deck, or what makes a great pitch deck?
Yeah, I think. Sorry, go ahead.
I'm really interested to see what you got to say.
I mean, just to add to that trip, so we avail ourselves of a service in Italy that does medical device engineering. So if somebody is in that medical device or development phase, we're also going to add a sort of a free consultation with Parametric Design, who are based there, who are also going to be at this event, but a one-to-one meeting. So so that'll be a bit of added fun to those that are coming. So guys, a lot of you, I looked at the delegate list, a lot of you know me already, which is also good and also bad. But following on from Hugh's pitch, it's some of these things will be overlapping, perhaps from a different perspective, as I'm at the lower end of Hugh's step diagram, where I sit in the world of an angel investor. So the thoughts I have around a perfect pitch, a route to market, the analysis and due diligence I would do on a project is slightly different, in so much as we're willing to take just that little bit more of a risk. We want to be more integrated in with the founder. We want to sort of help fill some of those roles that the founder may or may not have. And all of that support comes from what is now 12 years of history and making sort of upwards of 18 investments. So what we're doing now is we have created almost a fraternal approach to the teams that we have, where, funny enough, a mid-vent investee was supporting one of my new early stage founders. So, the whole idea of MedTech Makers Lab is to have this lab space, which is virtual at the moment, and for founders to support each other, and this sort of umbrella at the top that is, guiding and modifying and helping raise capital and address some of the more corporate concerns. But I'll just get into the slides and I'll try not to run over.
Yeah, so you've got about 20 odd minutes, Christian.
Perfect.
I think that founders helping founders is really quite interesting, because in some respects, unless you've been there, done it, got the t-shirt to raise money, you might have experience at investing and moving companies along, but founders talking to the founders can be a bit more of the kind of the social impact, the personal impact, as opposed to the business impact.
Yeah, and a lot of what we do across Europe now, we're running innovation programs in 9 countries. And a lot of what we do is all founder focused. And you'll see that on one of the slides. We're purely a founder focused sort of not investor, but an advisory and an investor. So, a bit about my background is, and I'll skip through that very quickly. I'm a retired investment banker. That was the Milli Vanilli, the one hit wonder. No, was it Milli Vanilli? No, it was Vanilla Ice. That's what it was. He had one song and he dined out his entire life on that one song. I built one business that we grew to £4.5 billion over a 7-year period. And I'm dining out on that story for the rest of my life.
Yes, but Christian, I don't think you've appeared on Dancing on Ice and danced to your own Vanilla Ice song like Vanilla Ice
No, I
did.
have not. I
No.
have not.
That's an aspiration for you coming
That's
forward,
an
isn't
aspiration. But we've had some other successes. At the moment, our portfolio sits at 9. And people say, why do you still do this? Because I keep using the word I've retired, but I haven't retired. I'm a deal junkie. I am addicted to the startup. And it's creating that early stage venture model that gets me excited. It gets me up out of bed in the mornings. I like to really dig deep into the backgrounds of the people that you're working with, because ultimately, if the founder is committed, we can help guide and grow. So I had to give myself a title, and I decided that I was going to be a mentoring strategist. And the things that we were going to do was develop corporate strategy, regulatory pathways, commercialization, but most importantly, is helping the company raise the right type of capital. And I'll come on to that, and I'll add a bit more to what Hugh has just said before me. This is where we work. This is the boring bit. These are some of our investments, and they're not all medtech. The thing at the top is an energy generating ridge blade. We haven't got it right all the time. That little vehicle you see there was a catastrophic failure, but we'll talk about that over a beer.
Yeah.
But if we take ourselves back just a little bit on innovation, the term innovation is misused a lot. It's a lot broader than what it is. It doesn't have to be a unique pattern. Hugh mentioned competition is actually healthy. Funnily enough, I would rather wear a frog watch than a Rolex, because if I had the Rolex on, I'd be consciously worried about scratching it or hitting it up against something, or at the moment, unfortunately, being held up for it. So innovation is actually, if you broke it down, and this was a definition I ripped off the internet, it's carrying out a new set of combinations. And it's that new set of combinations that then leads to creating a new underlying business model, whether it be through production, source of supply, creating process improvements. Now, as a lot of you know, my favorite subject matter is medtech. But along with innovation, you have to have an innovation pathway. Because if you have an innovation pathway, you can then develop a funding or a pitching pathway. And all of this sort of blends together. So the first things I'm looking for is there value? Or is it a solution to a problem that doesn't exist, right? So can we value something out of this set of bits of research? Because often I've seen great products, great services, but the market is just not there. And it's not going to be investable. It will become a lifestyle business. It'll become a nice little company that may, in the future, make up to be a part of a portfolio of a larger group of similar companies. Are the leaders focused on their future? And do they have then a strategic direction? The culture. Now, if you've heard me talk in person, I've been beating up accelerators and incubators because I feel like they're the cheer squad for an industry that needs a complete overhaul. It doesn't necessarily need to be bigged up anymore. It just needs to be broken and restarted. And then the rest of it that usually comes along with a bit of advice is, do they have the right insight? Are they managing uncertainty? And do they have a systematic approach of growing? And what we're learning is, well, how do we measure that innovation? And this is what you see. And I think this is outdated now. I think technology readiness levels are been there and done that. And so is this, the business model canvas. And what you see in most acceleration programs are founders spending 6 weeks, 8 weeks, if not longer, learning about value proposition, customer relationships. And my idea is that is the biggest waste of time for a founder who has a great idea that needs to gain traction. So what I took was something that was written in the 1980s by the Stanford Research Institute. And I feel like I can do an entire acceleration program in half a day. And these are the 4 main steps. And the reason these 4 main steps are also very important, because this is the basis in which you will tell the story of your pitch. And you've gone through some of this already, but perhaps with a different set of slides. So for me, the first thing, first and foremost, before you get into the tech, before you even tell me what you had for coffee, it's, is there a need? The story must start with a need in the market, a problem that you solve. And it's not just about understanding the need, but how do you access the need? What is the size of the need? Is the need too restrictive? Is it encased with regulatory issues? And understanding that is the first part of the founder's story. Often we get founders that have created a solution through something that impacts them personally. So it's born out of need. Because once I've heard the need in my mind, I'm now in a story that says, wow, I resonate with that problem. I understand that problem. And then the next step is to shine. You shine with your approach. This is how I solve this problem. And this is also equally as important. And we talked about IP and patents and why sometimes being the only person in the market is not necessarily a great market. But understanding how you might solve that problem better, cheaper, faster, or be the only way to solve this problem. And certainly what must follow very quickly is that this is how it benefits the industry, the market, the people, the planet, patient outcomes, whatever sector that you're in, there must be a reason why you're solving a problem. Otherwise, again, you're solving a problem, you've created a solution to a problem that doesn't exist, or a solution that may not be required. And I see a lot of this. Well, and this is an actual story, but I had a client who was solving a feminine, was creating a new feminine hygiene product when the existing product has been in the market for nearly 100 years. And creating a new product at a time where this particular method was declining year on year. So whilst he had something unique, something that was patentable, it solved a problem. There was no benefit to having an additional solution to this problem. And Hugh has labored on and spoken a lot about competition, which I think is very, very important. But one of the other aspects of competition is apathy. People sometimes just don't want to change. We've all had it. You pick up the phone and somebody wants to talk to you about changing a mobile phone provider. Or would you like to move over to a new bank, change your double glazing? You know, apathy is one of the biggest competitors to innovation growing in the market. But if you've addressed the need in a way that's quite unique, presented the benefits of that solution, then all of a sudden you've got a defense to apathy. You also have a defense to other competition, people that do a similar job. And this encapsulates the story that you need to present on a demo day or a pitching competition. Yeah. But this is not a business plan. This is what it is. It is an introduction. Often today, we confuse pitch decks with business plans. And we'll go to a VC or an investor and say, here's my pitch deck, and there'll be a fantastic pitch deck. One, they may not ask for the money. That's the other part. The second, then, my comment will be, well, have you written a business plan? Well, this is my plan. But this is not a plan. A business plan, we need to go back to old school, is a robust operational strategy to develop your pitch into something that generates revenue. You know, we have a program called Research to Revenue. In that, you have several steps of funding. Grants, the fools, I'm one of them. Then you get into angel rounds. Then you've got varying degrees of angels. You've got the ones that want the EIS tax relief and go, you know what, that's not a bad idea. I'll take 50% of my taxes. That trade instead of 10,000 is now costing me 5. And if you lose the money in 3 years' time, I believe there's a benefit for this as well. And then you've got the more sophisticated investors that realize that the growth of the company before a VC comes in is going to be quite exponential if the idea is correct. This is your really strong angel partner. These angels have invested in, historically been a founder themselves. They have entrepreneurism in their DNA. And if you can get a hold of these types of angels, they're the ones that drive your business better. So and again, I keep going back to Hugh, and Hugh, you did a fantastic presentation. You know, understanding what you need is equally as important as your entire business model. I'm not expecting a founder to be the CEO. I'm not expecting the founder to be the accountant or to have a robust, risk managed financial set of projections. What I'm expecting the founder to do is understand the technology, the logic, the patent, to have a development strategy around that product. So it's not vanilla ice. It's not the Christian Kumar.
So that's quite interesting what you're saying there, Christian, about having that strong angel on board who understands your marketplace, contacting the marketplace, because that works for both of you, doesn't it? Because they want, both you and the company that you've invested in, both want the highest valuation at the next round.
100%.
Because because then that'll reduce the dilution of both the business angels' investment in the company and the dilution of the founder. So, as you say, getting that really strong investor who's committed to helping you, choosing the right one with the right skill set and market knowledge and connections is absolutely crucial, isn't it?
Yeah, and angels follow angels, right? So there's a small group of angels I have in Birmingham. And, we meet every 2 months. We'll go out and have a couple of drinks, bite to eat, and we'll be talking about the things that we're doing. We're all of a similar age, a similar maturity level. We've all made a few small investments, and now we've gotten to the point where we're starting to share deals. Because having a strong angel on board will bring much more benefit through his network than through his wallet. So just so I don't fall too far behind.
Yeah, say 5 minutes, 5 minutes.
Yeah. So I'm not going to talk about accelerators. I think they're a broken model. A lot of accelerators need to go back to the venture building styles of the 2005, the Y Combinator era. And certainly at MedTech Makers Lab, this is our next iteration that we will launch at the end of the year. So considerations for a founder, considerations for an investor. I don't want to know how it does it. I want to know what it does, right? So that's the first thing. Don't baffle us with science. Do you understand your market? It's not, as Hugh said eloquently, it's not, here's my £1 billion market, I'll get 0.1% retiring millionaire. That doesn't work. You have to have a tactical roadmap to reach your market. That's what we want to know. Has there been a acceptance, a peer-to-peer review? Because today there's a stronger focus on traction and revenue. And this is very important here. Where will the money take you? When will you need money again? This is the layer of dilution. And then how have you valued your business?
Yeah, I think just going back to that previous slide there, Christian. So I was doing some work with a company who were doing an app for runners, and they were quite new to the market at the time, so they'd been out raised money. They had completely misunderstood two key drivers. One was cost of acquisition of a
Right,
new
yeah.
person who's going to, instead of being a freemium model where you get the basic one free and then this was theirs, basic model free, then you have to pay more. The cost of acquisition of getting a paying client, and then it was how long do they stick with you
Yeah.
to get, what retained value are you giving them for them paying paying a subscription. And they had miscalculated both of those, and for the next round of investment they had to analyze all their data and come up with a different proposition to invest. They got the money and it's been a success, but first time round they got it fairly wrong.
Yeah.
And we're in a real panic about that.
Yeah, and I think when you start out, your monthly recurring revenue is reasonably linear, but it's only after several quarters that you realize how much of that monthly recurring revenue starts to fall off. And you have to have a conscious effort to keep that replenished. So you're absolutely right. I'll skip this slide here because I think Joe's going to send the slides around. But
Yeah.
the one big highlight here is build a strong team. And if you're not sure or don't have people to fill those slots, ask your investor. Because we know as in early stage investors, you can't afford a six-figure salary. This is a repeating slide. This is what investors do. So we're looking for the size of the market, the solution, the problem. The unit economic model, this is quite important in financial projections. It's not just about revenue. It's about, just as you said, Sam, the cost of delivering that revenue or obtaining that revenue. So, what is the client acquisition cost? How long does it take to be in the market before you turn a prospect into a customer? Use and application of funds. People often don't provide enough detail. That's 1/3 marketing, 1/3 admin, 1/3 product development. Well, that doesn't work. I need to know more. And financial projections, oh my goodness, I can't tell you how important these are in modern times today. We have gotten past it's blockchain, therefore I'll get investment, or the vaporware in 2000s where I put 6 clever guys together and they're worth 10 million because of their collective brain power. That doesn't work now. We are more restrictive on looking at the detail of the business plan and when is the next round, right?
I was at a talk yesterday, Christian, just very briefly, and it was to a bunch of medtech startups in London. And I said, I think the best thing you can do as a founder is you get yourself on a 2 to 3 intense finance course. So you understand profit and loss, cash flow, balance sheet, fundamental tax, how to build a cash flow, understanding your cash flow, what are the drivers. So when you go to an investor, you might only have a small team. If you've paid an accountant to do it and they're not with you, you don't know your numbers.
Yeah, and you know what? That is so true because, and I'm sure there's a couple of accountants here. I have a fundamental issue with accountants because not all, some,
steady.
steady, because an accountant is really good at telling you where you've been. They prepare the history, they do your accounts, they manage your taxes, and they do that very, very well. Really look at the types of accountants and financial advisors that are forward thinking. And this is so important. They understand assumptions, they understand things like cash flow lag. You go to a lot of these acceleration programs, they teach you a basic cash flow, but value is not in cash flow, value is in balance sheets. And all the investors in the room, the accountants in the room will know that you develop value on a balance sheet. And the other thing is don't take short or dumb money. There are 3 main segments to growing an enterprise. There's the research, commercialization, and scale. Often a founder will have 2 or 3 rounds, the friends, family, and fools, the smaller angels, the unexperienced angel, the guy that was introduced at the pub. And you've had 2 or 3 rounds of dilution before you get into the commercialization element. And then what happens when you get to mid-vend stage and the founding team have maybe 40%, 45%, and they're going to then incur a major dilution? The investor at that stage is going to say, well, my founders are not vested enough. So we've got to get away from these multiple rounds of funding, understand and present where the money takes you. And this is quite an important slide because these are the types of questions that I will ask when looking at an investment deal. You know, the way you take on money affects future valuation. Avoid multiple rounds of funding. Look at your good money versus bad money. So take advantage of grants. I mean, TBAT, this is what you guys do for a living. Look at some of the non-dilutive ways, because you might think that, well, perhaps 6 months is too long to wait for a grant application to be approved. But taking on an interim round of equity, that dilution will hurt you later. And then make sure you've got a real growth mindset. And something that equity guys won't talk about is things like smart debt, invoice project, venture debt, things that are non-dilutive as the company grows. It generally doesn't work very early on, but it's something that's quite important. The landscape of investments is changing. And the two biggest sectors are charities and institutions and corporate venture capitalists. You know, you've heard the term patient capital. People that want to support an angel much earlier on, who now, because of things like MDR2, devices are taking much longer. So you need a different type of investor that has a long-term strategy with you. And with that, you've got to make sure your IP develops, that your product develops against the roadmap. I was at King's yesterday, a great piece of technology that has used an NIHR PDA grant, and they took a funding from the British Heart Foundation. Here they are now, 4 years in, fully developed product, and the founders own 84% of the company.
Yeah.
Right. So now their scale round, this is it's AI software in cardiology, but their scale round to get this out there is 2.5 million. You know, and it's just it's being able to map the strategy very, very early on. And again, that comes from people that have been in the market, that have been investors, or in some cases who have been ripped off because of their aggressive clauses in a shareholder agreement. So I'm always available to talk. Joe will send the slides later. I'm happy to talk to you about your pitch decks. Can't tell you I'll invest in everything. In fact, we've done 9 out of 260, to give you an idea. But I call myself the deal junkie.
Yeah.
There you go. I should be on time, kind of.
Yeah. You know what, Christian, and I kept butting, and I've got loads of questions, but there's a couple from the audience which are so. There's one question there about fashion items. So they're not solving a problem, but it's a niche product. And the kind of my initial thought there was you need to find exactly the right angel who got a belief that niche fashion product is going to make it. Because are you solving a problem? You're not. It's you're playing to people's egos and
building a brand. Yeah.
Yeah.
But even with projects like that, there are some great pieces of kit. One is called Bowhurst. The other one is called Pitchbook.
Yeah.
So if you know of a company similar to yours, so for example, if you were in the fashion game and you knew boohoo.com or I forget some of the other pretty little things, you would go and look those companies up, have a look at the cap table. You will know who the principals are, but have a look at the cap table to see who the investors are.
Yeah.
Because often that will then tell you the type of investment firm that will invest in your product.
And I think most importantly there, Christian, I think on Bowhurst, you can see the history of those investments.
Yes.
So you'll be able to say at this stage, they invested, oh, that's interesting, but they weren't involved in the later rounds. So perhaps they're the guys I need to talk to because they want to be involved earlier.
I mean, I do it all the time. I use Pitchbook, more than both. They're both equally as good as each other.
Yeah.
And they're not cheap.
I know Bowhurst is £10,000-12,000 a year at least.
Pitchbook is the same. Yeah.
But
so
you pay good money, you get good results, don't you?
You get good results. And for me, because I'm never a single investor, because I syndicate, I have built now probably a very enviable database of co-investors. And often now I've had investors invest in a deal where I've presented it. I didn't really want to put the money in. It wasn't my sector, but I've been able to get the other guys in there.
Yeah. Got a couple of other questions.
Yeah, sure.
A good financial course. I've never found one, and I keep meaning to set one up. So I'm an engineer who understands accounts as opposed to an accountant. So I build people's cash flow models built out on assumptions, and you can change everything. And if you've got if you've got a set of accounts, that's the front end, that's the starting. But it all, I don't know of any really good ones that I would recommend, which is a shame. Maybe I've not looked hard enough.
Now, I mean, I'm the entrepreneur in residence at the Open University. Now, the Open University runs a series of free courses for entrepreneurs. So have a look on the Open University website. They're not perfect, but if you can get a good grounding, there is a book. Oh my gosh, and I don't have it on my table. I will send Joe a book that I read, and it's Understanding Accounts.
Yeah.
And it was a little book all the way from early stage, single mom founder all the way to a large corporate. And I don't have the book and I can't off the top of my head.
Okay.
But it's the first book I read. But I'll send that to Joe. And Sam, we should talk about that.
Yeah.
We should talk about putting a course together.
So a guy called Graham, just a question. I'll probably look to answer this. If you receive funding from grants and you claim de minimis, not all grants are de minimis, it's kind of the more local ones. How does that affect investors when you look to raise the first large amount? I don't think it does. It doesn't. In some respects, grants show that somebody externally has objectively assessed your company and your business proposition, and they're willing to put money behind it. It's not a true gauge of what an investor would do, but it's waving a flag that somebody did. You've been through that process. So, okay, right, brilliant. Christian, amazing, as usual.
Can I just answer Lewis's question real quick?
Yeah, go on then.
Because Lewis, I know. Lewis, AI will not replace the auditor's function, but what the AI will do is highlight anomalies in accounts so that when auditors audit their books, it will highlight problems first so they can concentrate on those. Because I've been looking at that. I've been looking at the way we audit and do financial performance. Sorry, Sam.
There we go. Brilliant. Right. What we're going to do, folks, because I've so enjoyed this, I keep asking lots of questions. I do apologise for that. We're going to go straight on to Ed, who's going to do is then we'll have a 10 minutes break before we then just come on to Kodaks with Mukesh, and then we've got some really interesting stuff with the case studies and all about PR. But as always, Christian, an absolute pleasure. Thank you very much.
Thank you.
We do need to meet up to go out in Leicester.
We do. We do.
And I think we should work on a 2 or 3 day cash, profit and loss cash flow accountancy workshop. That doesn't need to be hidden in mystique. Just make it really easy for folks. I'll talk to you about that. Brilliant. Thank you very much. Ed.
Thanks, guys.
Hi, Sam.
Hello.
Thank you, Christian.
I believe I'm on slide detail. Am I not?
Yes, please, if that would be okay.
Hopefully. Right, I'll just share that. In classic style of, of course, it's not going to help me here, is it? Okay, so why is that not? They are the slides, but not the ones how I want to show them.
Do you want me to share, Sam?
Could you, Joe? I'm having a bit of a nightmare here for some obscure reason. So
no problems. I'll share now.
As the head of combustion engineer at Alstom used to say, Sam, you would never fly to the moon on a Microsoft system. And it just goes to show it can't be trusted when under pressure. But there we go. Right, I'll close that. Right, tell me when you're ready, Joe.
Is that sharing?
Stop sharing.
Yep. That worked.
Yeah, licensing out. Ed, right, there we go. Looks brilliant. Good. So, Ed, you got kind of 20, 25 minutes, please.
Okay, fine. Next slide, please, Joe.
Just interestingly enough, I had a night out with Ed last week for the England football match, and we ended up chaperoning Terry Butcher back to his hotel, didn't we?
We did.
I thought we were going to have to end up tucking him into bed with a cocoa, but thankfully it didn't come to that.
No, Joe advised us against that. Next slide, please, Joe. Okay, let's just get through that. That's in a sense the sort of four key fundamentals of what we're going to be talking about. So in the context of getting into some sort of arrangement that involves licensing out, by which I mean you are the licensor and you are effectively licensing some intellectual property to a licensee for a particular purpose. That is always preceded by some degree of discussion, which has to be treated in a context of confidentiality. Not only because of what is being disclosed, and ultimately that some of that may well be commercially sensitive or other forms of confidential information, such as trade secrets, but equally it could be vitally important know-how that you don't want to be disclosed to all and sundry. Know-how that perhaps relates to existing patents and how you work those patents, but equally potential innovations. It's vitally important that you make sure that there's a strong footing, and that footing is contractually covered, and a confidentiality agreement, in my view, is worth its weight in gold in that respect. Not only identifying what that type of confidential information actually is in its nature and form, but also what the permitted purpose for disclosure actually is, and that in itself doesn't in its own right constitute a license of any sort. It's just simply to, at a pre-contractual level, establish what you may want to do going forward, and that may be that you don't want to continue to having those discussions. You don't want to enter into a licensing arrangement with that potential candidate, licensee candidate, but equally, it may well lead to something by way of a licensing out arrangement.
And I suppose it's really important to make sure you keep copies of those, and that you try and get some consistency, because if you've been talking to a number of companies as you go through the process, is it important to keep copies of everyone, so they can say what conversations have you had and how are you protected?
I would say so. All along, it's an evidential chain of information that you're accumulating, and that's for a number of reasons. Not only to determine what is the footing and what has actually been provided for that may well be disclosed, but actually it could well have a forensic nature to it, in the sense that if there is an unauthorized disclosure, then you can begin to fathom where that unauthorized disclosure crept up from, and who may be responsible. Yeah. And what rights you may then have in those circumstances, as stipulated by the agreement. But it's important to be very clear on permitted purpose. It's important to make sure that you're just essentially disclosing what needs to be known, going back to Donald again, and disclosing it on a need-to-know basis, ensuring that only the relevant people and parties within the relevant recipient are receiving the information. And they should ultimately be relevant to the purpose and actually the potential future relationship at a contractual level that you want to get into. Next slide, please. So we're sort of taking this stage by stage. Some of these stages are, in my view, not necessarily required, but the first stage regarding confidentiality certainly is at a pre-contractual level. It then is often useful, particularly in areas of some complexity or commercial complexity, to have where you suspect actually it would be useful to actually have something written down to fathom whether key constructs regarding a potential deal, transaction, or relationship are understood and mutually and consensually understood in an accurate and consistent way. I find that heads of terms documents or letters of intent or memorandum of understanding, there are a multitude of names for them, but they have real importance when it comes to identifying what those areas might be, and actually stipulating what the key constructs of the agreement actually are, which can then be very useful in informing and foreshortening the process of actually documenting it in a formal contract. Now, they're by their very nature non-binding, although they have moral force. But nevertheless, they do have they have strong importance in my view. Not necessarily vital, but strong importance, and it's often a very useful step to take, just to get that consistency and understanding. And it may well be elements of it that you actually want on a sort of item by item basis, or in a general sense to make binding. And some of that relates to the process itself of pre-contractual discussion and having moments of exclusivity or periods of exclusivity that apply It could also relate to items such as confidentiality inherently on an ongoing basis, and also, you know, the sort of law that applies and governs the discussions and ultimately the agreement that hopefully results. Next slide, please. So here we get into just out of interest, Sam, how many slides have I got left?
You've got 12.
Okay, fine. This is the meat of what I'm about to say in many respects. This idea of what considerations you really need to have at the forefront of your mind when it comes to taking intellectual property that you own, or indeed intellectual property that you are licensed to use, and then in the case of ownership, licensing that on to somebody, or in the case of a licensed position, sub-licensing that on to somebody. The features and the considerations are generally the same. And again, I'm sort of briefly glossing over the fact that actually at a point, if the intellectual property is far more workable or far more valuable to someone else, you may want to assign it all to that entity to then effectively take over ownership and progress from there. But the price tag for that is obviously an inherently higher matter than the price tag that applies to an ongoing license arrangement. But
and is some of that driven by market size? So I'm dealing with a company who's got a single-use, high-volume medical product, and his initial concept was it developed it so far, and he thought, right, I'm going to basically sell the IP lock, stock, and barrel. And so he went through that route for 18 months, and it was really struggling. Then one of the companies we've been talking to said, we just want a non-exclusive license because we've got this drug coming along that is falling out of patent. We've been developing it. We're not bothered about an exclusive license. We want a mechanism that allows us to sell our drug, as opposed to we want the device and stop anybody else from using it. So the licensing deal has completely changed. It's still worth an absolute fortune to the fella, but he's changed the shape of the deal outrageously because he just didn't realise that would be a thing.
Entirely right, Sam. You know that there are two considerations, and these are very general and broad considerations. But one is the capability and resourcefulness, or sorry, resourcefulness is probably not the right word. The having the available resource to be able to take full advantage of a piece of intellectual property, or whether in fact it is better off placed in the hands of another individual. And again, if you're honest with yourself, and actually that placement is probably best done in its entirety, then so be it. If it's best done partially, also so be it. But actually, if you want to maintain ownership of something because you feel it has more adaptability or potential application elsewhere, or you just don't feel that you have the market understanding or the geographic understanding, you know, to be able to take full advantage of it at a sort of domestic or global level, that's when you begin to consider licensing. And you know, you make the hard work part of the, I suppose, attraction, because someone else is far better placed to take full commercial advantage of that particular matter and provide you with a percentage. So you have all of those considerations to factor into any decision about assignment or licensing, and at the same time what it is you're actually going to be reserving, and not in any respect granting rights over, because you need to be fundamentally clear what it is being either transferred in terms of ownership, or in fact opened up to a licensing arrangement and capable of being used in the hands of another. And you shouldn't be overzealous in that. You shouldn't be over licensing, and you certainly shouldn't be over assigning. But you also need to think about the potential territory in which this license is being granted, and whether that's being sort of broken down in any particular respect or subject to caveats because of existing arrangements, or whether in fact it's something not just territorial that you're granting, it's actually a field of use within a territory, so it's not as expansive as it could be. But all of these are to be assessed in the context of what you already have in place, and some of this is potentially driven by that in many respects.
I think that geographic one is really quite interesting, because you might have a piece of tech and you want to license it to a company, but there's no point giving them a worldwide license if they're never going to sell to the Far East.
No, absolutely.
They're never, by the time they've got to the size where they might want to go to the Far East, the patent could be waning, kind of thing.
Entirely right.
So you need to think tactically about who I'm going to approach and why, and what's their coverage, what are the resources, as you said previously. But that geographical piece is quite important as well, because you might say, I'll give you Europe and that's it, maximum, because there's another deal to be done over there.
I agree entirely. And again, bearing in mind the types of license that you can afford, it has to be geographically appropriate if you're granting, let's say, an exclusive or a sole license. Exclusive license being at the expense of everybody. In fact, you as the licensor need to step out of the equation because it's exclusively within the remit of the licensee to work that package of rights that have been granted. And a sole license equally in many respects, because that's just the licensor and the licensee that can use that package of licensed rights. A non-exclusive, license is you can be reasonably philosophical about that, but again, not totally, because you don't want to hamstring yourself if, to the extent that there's a possible exclusive arrangement that could arise in respect of a given territory that you are conflicted from taking because of an expansive non-exclusive license that would prohibit that. So it's you've got to be extraordinarily careful, and also, in fact, you need to think about the IP rights in question and in the hands of yourselves or others, whether they will be developed or improved in any way, and whether the license that you're granting needs to cover that, or whether in fact that has to be inherently the subject of a separate license, because it actually moves away from something that is speculative to perhaps something that's concrete, and then the concrete element is now the commercialization going forward.
Yeah.
Next slide, please. So this is back to the exclusivity point, and the reason that these conditions and considerations need to be taken into account is that you are sacrificing your rights, not to the extent of sacrificing ownership, because the extent of the license is for whatever given term that you apply it, which in itself is a very significant consideration. But you need to understand that if you are affording exclusivity or some sole position, there needs to be very strong minimum performance or minimum return requirements that you expect from your licensee, because otherwise, the right sacrifice isn't receiving due consideration, and that's ultimately why you're getting into these commercial exploitation-based arrangements.
I think what you just mentioned there, Ed, about so I was doing some work to do with a jockey wheel. This is going back 20 odd years now, and he licensed it out, but because he didn't know how long it was going to take that company to get it to market and get traction, because he had a royalty attached to it, in the license agreement were minimum royalty payments year on year, whether they moved it forward or not. Because because they were an international company, so they got international market, he says, because it could still take you ages, you need to be giving me money on an annual basis.
Absolutely.
Because of that exclusivity.
And it's an interesting mechanism, because actually affording that an exclusive right or a sole right, it gives them a market lead. It gives them an edge, and a very valuable one. Now there has to be appropriate return on that, and failure to achieve the appropriate return needs to crystallize rights to get out of that arrangement. It can be as stark as that, or to at least get, in order for the licensee to retain that exclusive or sole position, there needs to be a balancing payment made, or a balancing return of some description, or it's a downgrading of license entirely to a non-exclusive position, thereby affording you the ability to go back to market again. Next
and
slide,
so as within your role, Ed, do you get involved with those negotiations around, someone's got a piece of license they want to rent to license out, bit of IP they want to license out. Do you get involved at that heads of terms point to help them shape what, because obviously you've done loads of these, whereas person with the IP probably hasn't. So you'll say, okay, they're trying to trip us up here by introducing this. What we're going to counter with A, B, and C instead, because that will protect you. So,
well, ideally, Sam, that would be the dream situation. You get started at the, do we need a confidentiality agreement? We're about to have some discussions. In other words, at the very outset and inception of a proposition, perhaps. And then, yes, we would, then work it forward as it needs to be, involving heads of terms as necessary.
Yeah.
But almost certainly, the earlier we can get involved and begin to iron out some of the considerations from a licensor perspective in licensing out anything of an IP nature, the better. So just quickly looking at some considerations when it comes to non-exclusive licensing. Again, I've touched upon one or two of these already. This idea again of making sure that again the scope of the license is appropriate and not fettering you unduly going forward with regards to any other types of license or areas or fields of licensing that you want to engage in. You also need to be conscious of any attempts by the non-exclusive licensee to restrict terms restrict the terms on which a licensor themselves can potentially grant licenses to other people. This idea of some sort of most favored nations position where if and to the extent that there is something more favorable that you're granting to another licensee on a non-exclusive level, whether in the same territory or otherwise, there's some kick in at that stage that then gets the previous licensee to the same position. You need, all of these deals have different pressure points and considerations that are factored into how they're structured and particularly how they're commercially dealt with. So to my mind, there's never a complete like-for-like scenario that would justify that position. So it's best removing yourself from it being a possibility. Just from the point of view of this idea of the idea of trying to generate a like-for-like arrangement and have that actually impact on how ongoing license fees are considered and structured. Again, that's to be avoided. And anything that sort of compromises, I suppose, what is dealt with and agreed at the outset by way of royalty rates, whether they're increasing royalty rates or reducing royalty rates, depending on the nature of the technology and its inherent value, and in all possibility, its inherent sort of success and moving into much more fulsome commercial exploitation. All of this is in a sense to be agreed at the outset, and if it can't be agreed at the outset, then shorten the term and potentially revisit and or set up a new licensing arrangement to be far more informed come the time. This idea that things can be adjusted and to the licensee's benefit reduced perhaps because of substantially similar circumstances arising or some, again, most favored nations position needs to be avoided at all costs. Next slide, please. And then again, I don't really have much more to say on this. I think we can probably work through this. It's just a subtle distinction on what is in essence an exclusive license. This is an out-and-out commercial proposition. That there are no particular legal frameworks that govern how you set up and structure the commercial returns from a licensing out arrangement. That they take probably one of three forms. One is a sort of an ongoing license fee type scenario, and again, much of this depends on the technology in question and how it's considered when it comes to assessing whether license fees by themselves are appropriate. For example, annually paid in advance, or some sort of ongoing subscription model, or whether you involve royalties as well on the basis of commercial returns that follow from the utilization and working up of the licensed IP. But it's also very much and very clearly affected by whether you're entering into a licensing arrangement at the outset pre-commercialization, or whether you're entering into an IP license that allows immediate commercialization, in which case royalties are by far the favored consideration. There may be an upfront advance or an upfront form of IP license paid to get over the threshold, as it were. But then it's an ongoing. I
was involved with one deal licensing out some technology into renewable energy, and so there was a lump sum up front, then there was a 9-month period then to further develop, both companies to develop the IP further, and assuming it met certain performance milestones, there'd be a bigger lump sum. And then the same for another 18 months and an even bigger lump sum, and then a royalty when it got exclusive, when it went into the marketplace, kind of thing. And so they were continuously buying exclusivity, and they were looking after the cost of the IP maintenance as well. That the licensor was, not the licensee, because that's in, and the structure of that deal kind of made sense to me because it was high risk. It was early in the development cycle. And so you weren't going to be exploiting it tomorrow. You'd like, a drug delivery device that get it through regulatory 6 months, boom, off you go, let's make some money. This was a 3 or 4 year development process to get that commercial product out there. So milestone payments planned against proving the technology at different scale was really important to them.
Couldn't agree more. This idea is particularly of a sort of a slightly unfathomed piece of IP. That has to be the case. It surely has to be at every sort of sensible level from both parties' perspectives, actually, because from the licensee's perspective, they rightly want the position to effectively call it a day at some point. We plugged this and we plugged this, and we thought we could do it, or we thought the research was supportive of the idea that this could be developed, and it just hasn't proven that to be the case. There has to be sort of realism about that in respect of that particular type of IP that's not yet proven. There has to be a sort of staging of the sort of payment process when it comes to license fees and or royalties.
3 or 4 minutes, Ed.
Yeah. So next, and again, there's some sort of various different types depending on the type of arrangement that you're considering. This goes back to, again, little factors that you can sort of incentivize with and encourage licensees with, from the point of view of how you consider what is due return for the licensor in respect of royalties and or license fees, but at the same time for the licensee themselves to justify their sort of the costs that they're incurring and the endeavor and the resource and so on that's required. And that may well, as you say, Sam, extend to this idea of the maintenance of the intellectual property to the extent it's registered.
In your experience, Ed, is the calculated percentage of the licensee's profit or turnover? To me, turnover is a really obvious thing because you can see it in the accounts. And they're selling loads of products. What did you turn over on those, that musical instrument, that banjo? Oh, well, we sold 500 of them at £1,000 each. 500k, I know your turnover. I'll have 2%, thank you very much. If you then have to start working out a profit of those banjos in that musical instrument company, you're onto harding to nothing, aren't you?
It's a very difficult task, and there's so much time that can be spent on that, either in heads of terms or in trying to then document it thoroughly and completely. And again, that's a task in its own right. Exhaustive documentation of a net profit concept from a gross turnover position is terribly difficult, and a really it can be quite a vexed argument with all parties involved. From the licensor perspective, you're trying to get a net profit position you're trying to get a gross revenue position when it comes to a certain percentage being received of that by way of royalty. From a licensee's position, clearly you want your costings taken into account and a net profit assessment of the relevant percentage when it comes to royalties paid back. But again, there are ways of working that around, and the licensor themselves could get extra supplementary fees for service provision when it comes to the provision of potentially even know-how or technical assistance and the actual delivery of that in a training context. That there are ways and means to sort of liken it almost to a house sale where you're trying to get into stamp duty thresholds. You can do a little bit of commercial magic when it comes to getting the right sums to each party. Next slide, please. This is just, again, it's important to, bear these particular things into account. The previous slide at the very end, I think, said currency fluctuations. That this is about tax and whether, in fact, monies are being received by the licensor, in effect, grossed up, with tax already taken into account to the extent it's applicable. There are a range of other sort of potential tax considerations that apply cross-border particularly, and some of those are itemized there, but I don't want to steal the thunder of tax experts unnecessarily at this time.
So what's interesting there is that the guy with the medical device is asking me about patent box. So because he's doing a non-exclusive license, he still owns the IP and he can claim that tax reduction on the royalty fees received. Because he still owns the IP and he's got the right to still further develop it. So for him, he's getting the money for having licensed it out to them non-exclusively, but because he still owns the IP and owns the patent and paying for the maintenance of it, he then still gets the right to that patent box tax advantage.
And this is it's invaluable to have discussions with the likes of us or even the likes of yourselves at the point of inception of an idea that you might want to go down this idea of licensing. It's vitally important to be fully and completely informed, and all of the sort of impacting factors will lead to various conclusions around what needs to be covered off in terms of commercial arrangements, what it is you feel you need out of the by way of return from the the licensing out position, bearing in mind these reliefs you may be receiving, and bearing in mind again what is befalling or affecting the licensee themselves. So Yeah, it's a very big consideration in the round.
Yeah. So got a question here, Ed. Small company with a new product looking to work alongside a multinational company. They have in place an NDA and a memorandum of understanding, about to negotiate a commercial agreement. How can I obtain support from with the negotiations? So Innovate UK Edge, they can't offer any advice because they're not in a place, I think, legally to do that. I think really, unfortunately for this chap, he's going to have to pay some money to get the help he needs to protect him fully.
Well, he is. He's going to need to talk to the likes of myself, an experienced commercial IP lawyer that understands, the workings of these types of negotiations and how to properly provide for the licensor in these given circumstances against a licensee of such scale with presumably certain requirements.
I might be putting you on this. Might be putting you on the spot here, Ed, but do you offer like a 15-20 minute chat just as a way of introduction to sort of to have an initial chat with somebody, cover some bases, and then it's like, okay, well, in my view, you need to do A, B, C, and D. This is what our fees will be, but that initial 15-20 minutes is.
Yes, absolutely. This idea that we're trying to establish what the nature of the task it is, the type of advice that's required, and how best to approach it. All of that has to be factored in before you can then determine what the best fee arrangement is, and that fee arrangement again can be protracted in terms of. It doesn't all necessarily need to be paid for then and there or on a monthly basis in a normal way. It can be very sort of creatively structured to build out of a position where there's then a degree of commercial return coming forward.
And what I have seen before is on a licensing deal where if it all fell apart, then the first 20 grand's worth of the company's legal fees were being paid by the licensee. Because they said, we recognise you're a micro company and got two farthings to rub together.
Yes,
and
but we really like your IP.
So there's a couple of ideas there to GH.
That's a really interesting one. This idea that again, another matter to factor in is this assumption of legal cost and who takes that responsibility. Again, depending on what is being provided for and the value to the eye of the beholder and the licensee in a given case.
Okay, we're going to have to romp on, Ed. I keep interrupting.
No problem at all.
We're now 20 minutes late overall, so I'm doing really badly, and Joe will be telling me off. So,
well, how many slides have you got left then?
When licensing, you got 8.
Okay, let's move through the next. Let's do this. These are again just considerations to be thought of when you're dealing with sort of intra-group licensing arrangements. They're not particularly external to the group of companies in question. So let's move on. Again, we've talked about the idea of maintenance. It's a key consideration as between the licensor and the licensee. So again, that's definitely to be factored into the commercial position. In any context, when there's a grant of rights, there should always be warranties that attach to those grant of rights. From the licensee's perspective, they'll want to know they have freedom to use. It's not going to cause them to trip up over anybody else's rights that have been granted. They won't actually be engaging in something that becomes or is non-infringing by the nature of utilizing those rights. But from the licensor's perspective, again, you want to be granting as few warranties as possible, and you want to make sure that they're the main warranties and not little sort of bespoke or tailored ones in particular. So the idea is really give what's needed in the context of non-infringement, validity and subsistence, and I suppose origin, and that should probably be the extent of it. And again, if and to the extent that there are some greater sort of global reach-based warranties that are being sought other than over and beyond what you have by way of registered jurisdictions, you again need to be caveating that with a reasonableness or as far as you're aware, that type of thing.
Yeah.
Warranties in essence will always, if they're going to have any particular bite and distinction from normal terms that exist within a contract, will have to have some sort of indemnification provision backing them up. And the question then becomes whether that's an open-ended indemnity or in fact needs to be limited and capped in some particular way. Now, I would ordinarily argue that if and to the extent it's quantifiable, it benefits from the idea of capping. But the likelihood is that, particularly taking an IP infringement matter, it can't really ever be quantified in advance and it be kept as open-ended as possible.
Oh, so that's quite so. So just on that, Ed, if I've licensed a non-exclusive license or even an exclusive license, and somebody infringes that IP in another jurisdiction,
Hmm.
does the licensing agreement have to make it clear who pays to fight that infringement?
It does. Yeah, you're absolutely
Yeah.
right. You know, if in any licensing arrangement, and you can begin to bulk out an agreement quite sizably in this respect, but it has to be done. I mean, at a practical level, it has to be done because that, you know, it may be that's the expectation of the licensee that the licensor takes on that primary responsibility and you know, pays for all the associated costs, but takes the lion's share, if not all of the winnings, if and to the extent that then sort of manifests itself. But equally, you're dealing with something that is highly likely to be in the jurisdiction of the licensee. So the licensee, at a practical level, might be the one who's got the best position. They might have the best position from the point of view of being best able to protect the rights as against that particular infringer. And it may well be that they just simply need the help and assistance of the licensor, and there's some sort of sharing arrangement around the cost, or actually the winnings, as it were, as well. So yeah, next slide, please. These are just considerations around sub-licensing. All I would really say is that a sub-license should never vary too far away from the license pursuant to which it is being granted, and it certainly shouldn't look to be in any way materially inconsistent with that.
Yeah.
Next slide. And again, we touched upon this idea of duration. There are different considerations clearly from each party's perspective, and there will also be different considerations again from what Sam and I have discussed around, you know, items of IP that aren't yet particularly proven, and items that can't be readily commercialized from the outset. So there could well need to be a breaking down of effectively licensed term, but at the same time, your average licensee is obviously going to want a longer term, and your licensor will want to fragment it into achievable, manageable shorter terms, or at least have that incentivized by way of minimum commitment requirements.
Yeah.
Next slide, please. And that looks to be a fairly decent summary of the 8 key points.
So there was one question, because this is a really complex piece of legal stuff, isn't it? So the answer, you know, is there an easier way of layman's terms? And I think those 8 bullet points saying these are your main considerations. So that's what you need to be aware of, kind of thing. The detail you spoke about higher up is the detail, isn't it? And
it is.
Okay, the scope. Well, what does it mean by scope? What is the scope of my IP I'm licensing? Actually, all right, okay. So
yeah,
I think the moral of the story is if you're licensing IP, take some professional advice, because you owe it to yourself to invest some money at this stage to protect yourselves moving forward. After the money you've invested today, getting it to that point, the money you've invested in patents and maintaining your IP, spending some more money to get this piece right is absolutely crucial.
It is. And the top 2 and the bottom 2 are, in fact, the key considerations at the outset, as well as, to an extent, payments. But in amongst payments, tax, maintenance, and warranties and indemnities all factor into what payment should be made.
Yeah. Okay, Ed, amazing. Thank you very much.
Pleasure.
That was an absolute whistle-stop tour. Well done you. Well done you for doing that. Okay, folks. Thank you so much, Ed, and thank you, Shakespeare, for sponsoring the whole innovation challenge. Amazing. So, folks, we're going to have we're not even going to have a 10 minute. We're going to have 8 minutes, because we're going to come back at 3 o'clock, where we've got Mukesh, and then we've got a couple of real life case studies of people who are going to just talk about their journey, and then all about PR and the power of that, of actually getting your name and brand out there, and the power that actually means to you as a company. So let's come back in 8 minutes, 3 o'clock, and we'll move forward. Okay, thank you very much.